My name is Amy Moore, and I'm with Tradeshift, and we're here today to talk about supply chain payments. What are businesses getting wrong today about supply chain payments?
Businesses these days are, I think there's a lot going right with supply chain payments today. And, when I look at, supply chain and payments, I think they are still today in many instances, very disconnected, right? So you have a transactional accounting process that runs very well, right? People are starting to connect together electronically to transfer information and drive more process efficiency. And then you have separate platforms that are focused on payments and lending and finance. And these are very disconnected solutions today. Mm-hmm. And I think, the big challenge that creates is inefficiency, right? Mm-hmm. And that inefficiency results in friction between buyers and sellers. It results in, what a lot of people call as portal fatigue, right? Businesses needing to go to multiple places to check on the status of a transaction, to see whether or not the payment's been executed. Creates a lot of confusion, erodes supplier relationships, it adds costs, and it sub-optimizes from both a cost as well as a working capital performance perspective. So I think that's a big challenge that companies are up against today. Both solutions in their own respect they're very mature, but I think we're just at that inflection point where it's all coming together. And that's what's really exciting about what Tradeshift's been doing as an organization, to bring together buyers and sellers with their funding partners and their banks to create the most efficient processes and help improve margins and working capital for businesses.
I think if I can add to what Andrew's saying, absolutely agree. The platforms are different, but I think it goes even deeper. It's not only that the platforms are different. When you look into any organization in a company, it's the teams are different. They sit separately. They don't even know who they are. The leaders are different, and so it almost goes to a depth where they're not even talking to each other. So they're not even actually asking themselves, should we actually have a common platform? So that's the sort of challenge that we are facing as we go in and say, what about connecting this, right?
Totally, and it's almost like how it used to be in the sales side of things, right? On the commercial side, before the advent of Salesforce. Salesforce was this great unifying factor where all of a sudden now we've kind of codified what that process is. We can prove that it actually works, with facts and figures, and now we can actually begin to see that people are essentially changing their organization, to actually make use of that in a very efficient way. And I'm kind of seeing that happen with essentially the whole department around the CFO. All the different functions kind of realigning, repatterning themselves to actually make maximum use of all the new tools and financial opportunities that come along with that.
So this is really interesting. What is the outcome, though, of all this inefficiency? And that you're kind of naming the cause of a problem, but what's happening for suppliers at the other end of all this inefficiency and disconnection?
If as a supplier you have to wait for 45 days, 60 days, 120 days, sometimes even 180 days to get paid, it creates a lot of burden on that supplier. Mm-hmm. And it's an opportunity missed for them to be able to invest that money they could have gotten on day one to be put back into the business to grow their business. Mm-hmm. So that's the challenge that the supplier faces, that their hands get tied time again and again, even though they have actually done the work and delivered the goods as well.
Right, and they're not innovating as a result, right? So you're not actually getting more out of your supply chain as you go along. You just essentially get more of the same, maybe with some of the corners, shaved off because of all these issues that they have with cash flow, where they could have been using that to actually provide innovation that can drive your business forward as well.
It's a great point, because I think, when early payments and efficient processing is not available, it creates issue-led conversations, right? And it erodes the relationships between buyers and sellers, which adds cost. It reduces trust between the parties, and in the end, it stifles growth, right? Whether it be in terms of innovation or being able to access cash, like you said, to bring that back into the business and focus on growth and delivering more goods and services or innovating. So I think it creates a vicious circle that has a lot bigger impacts than people initially consider.
today's CFO must be thinking about the future, and they need to be thinking about things like growth and innovation, not just processes and efficiencies. So what are some of the future forward-looking CFOs doing to address this problem?
Well, I think it's also, first of all, we talked about the supplier problem. I think we should actually talk about the buyer problem as well. So before, the CFO actually usually sees the lens through his own company, and that's actually a challenge today. They actually don't really see the supplier problem as much. And I think the problem, and probably Andrew, you should actually go into describing that in detail, like what are the challenges the CFO faces and that they need to solve for today that they're thinking about.
Mm-hmm. Yeah, I think, in general, every business has, parties they're interacting with. They have a supply chain that they need to ensure has access to the liquidity they need. They can't have disruptions in the supply chain because it can create huge impacts in the business, right? And I think, if you look at, for large corporates, the buyers, right, they're graded heavily by the analysts and the financial analysts on their working capital performance, right? So if they're not getting the most out of their working capital, it has a huge impact on the market capitalization of that company as well. So I think, from a CFO and a buyer perspective, they need to get that mix right. Mm-hmm. And, I think some of to your question, I think some of the more forward-looking CFOs are now looking at it from the perspective, I need to bring this all into kind of one integrated payment wallet to make sure I'm putting the right solutions in the right areas of my supply chain. And, when we typically talk with customers, we're talking about, 4 axes, right? It's payment. What type of payment method should I be using? It's funding. Should I be using my own cash? Should I be using financing from my lending partners? It's timing. When does this timing need to occur? Do I need to give ultimate assurance to my suppliers immediately to get them paid as soon as possible? And then it's cost, right? What are the cost of funds? And what are the cost of funds for my supply chain? How can I help them? And what are my own cost of funds? And what should I be doing with the cost associated with those payments as well?
Can I
Yes.
try? So I think one of the themes the past few years has been how the CFO roles change into a more strategic role for the company. And I think what the CFO is faced with today, that is actually to understand both the technology part of the business and the cost part of the business as well. And that means you need to understand how digitization helps your business achieve, success. There was a very well cited study in early 2000 that was called the AAA supply chain, I think. And there really was an empirical study that showed that companies that invest in the agility of their supply chain actually have a competitive advantage over companies that primarily invest for cost efficiency in their supply chains. And I think that, of course, puts digitization as a kind of key agenda topic for the CFO. Mm-hmm. And some of the things we have talked about today, I think those are really the low-hanging fruits, like it's immediately visible if you digitize that you can start automating payments. Through automation of payments, you can optimize your working capital flow. Mm-hmm. So I think that's a very simple one. Mm-hmm. I watched some of the panels at Davos this year, and there was a lot of talk about using digital for efficiency in the company. But what really struck me was a lot of the themes were about driving efficiency inside of the company, but less about how digitization of the supply chain. So the whole ecosystems of trade, your banking partners, logistics partners, suppliers in first, second, third tier, so helps you to drive agility and efficiency. And I think that's really key. So every company today is kind of tasked with taking full responsibility for what they produce and how it's produced. And digitalization can help create that insight and drive that agility. But today you're lacking incentives in the supply chain for participants to digitize. Mm-hmm. Why has supply chains not been digitized for 40 years? And actually unlocking part of that capital that is today locked up in the supply chain, I think is one of the key answers to achieve that digitization. And it has not been possible for many, many years because access to digitization was very hard to come by for most companies in the supply chain, but we are at a different place today.
Help me understand what the early payment options are.
That's a good point. I was actually just going to expand on that, right?
Yeah.
We talked about, transactional accounting, purchase to pay and order to cash, being electronified for lack of a better term, and that being a relatively mature set of options these days to help digitize the transactional accounting process. On the working capital and payment side, if we just look at buyers, for example, they're leveraging many tools today. It could be supply chain finance to improve working capital and get access or get the supply chain access to liquidity as quickly as possible. It could be dynamic discounting to leverage some of their excess cash and liquidity to drive margin improvement and get their suppliers paid early. Or it could be using different types of virtual card technology to drive more efficiency in the transactional accounting process. I think each one of those tools are relatively well established today, but now what we're seeing is that convergence of electronic experience and supplier information management and registration with these payment tools.
And actually, I think on top of that as well, you have these different types of tools, but if you can layer them across multiple financing partners in different markets for different options, and then ultimately, and that's also maybe a little bit towards the previous question, where does the CFO see that then go, is to move it away from this very technical infrastructure kind of thinking that you started out by saying, and talking about, oh, these systems are completely disconnected. It's all about technology, and it's not really where it should be, which is about what is actually my working capital strategy as a CFO. And do you actually then have, across all of these tools and across all of these banks, the ability to actually pull that lever and say, my cash strategy is this right now. This is where I want to be, and have the tools actually help you drive towards that strategy. So we can talk again about what Gert was also saying, like, a seat at the table, being that more strategic party, rather than somebody who has to understand a lot of accounting, a lot of financing, and a lot of technology, right? That's not their core business at all. It's about, maximizing the company resources. And I think that is where it ultimately needs to be, and what any platforming, in that space will start having to provide.
It's an excellent point. I think you made the point about the banking partners as well, right? Any of these solutions these days need to be multi-bank, right? You need to be able to work with the banking partners that you're working with today. It prevents funding concentration risk. It allows you to have the currency coverage you need as a global organization. And it allows you to reduce the risk of things changing with certain banking relationships. For any of the large corporates, they're working with 4 to 6 major international banks, and they need to be able to use the right banking solution in the right regions to support that working capital strategy that you mentioned, Thijs.
I think what's interesting to me is all of this has been around for 20, 30 years. Actually, you have had supply chain financing solutions, you've had dynamic discounting solutions, you've had invoicing solutions. And what's really interesting that we are trying to do is we're trying to bring all of this together on a platform, so you can actually have multi-bank partners, and you can actually have one system which can work in the US and in Spain and in Mexico and so on, right? And that's very, very powerful.
So I have one last question, and I want to go back to the future. You've been talking about buy-side supply chain finance. Why aren't we, in the future, are we going to be putting this more in the hands of the suppliers?
I think it would be. Yeah.
Absolutely. I think 5 years from now, supply chain financing is probably dead as we know it. And when we come to these single platform solutions, as we're talking, what you can do is standardize terms across the platform. And once you start standardizing the terms, you know that you know the likeliness of the buyer to pay. So you can actually have solutions which go directly to the supplier and offer them financing, regardless of whether the buyer really wants it to be in or not.
Yeah.
I think it's an excellent point. And I think, supply chain finance is going to be different 5 years down the road. I think transactional banking as a whole is going to be completely different 5 years down the road. There's so much information available now that you can leverage data and information to create engagement and context-sensitive finance offers. If I look 5 years down the road, I believe payments for everything are going to be immediate. There are going to be multiple options that buyers and sellers can select from to, again, find the right payment method, the right timing, and the right cost or working capital option for themselves, and that payment will be immediate.
And I actually think it's ultimately just going to completely wipe away the difference between all these different models of finance. They're all coming from a different background and operating under different constraints. It's going to be far more of a continuum, sort of like you were saying, where at the end of the day, you're just facilitating an exchange of value within a certain risk model. And if that risk model now is far more multidimensional, and maybe with the use of AI and so on, can be dialed in almost on a per transaction basis and get the right finance, the best possible option available to the seller at any given time, then we're not going to be talking about dynamic discounting, supply chain financing, and all of those things. It's just going to be business.
Mm-hmm. So it's almost like
Trade.
Going from 90-day payments to day one payment to negative 30-day payment and so on, right?
Yeah.
Yeah, I mean, it's quite profound to think about how you can start a conversation with something as mundane as invoicing and payments and end really with economic opportunity for all.
Yeah.
I want to thank you all.